All right, we are back for another live stream show. U.S. stock market futures are up a little bit tonight on news, on rumors that Pfizer may have potentially a vaccine that many of us don't want in Q3 or Q4, that it's making progress. However, in the upcoming, this week coming up, there is a lot of important earnings for Q2. And we'll find out exactly how bad the damage is. There's obviously going to be excuses because this is what senior executives are good at nowadays. They're good at financial engineering, manipulating the balance sheet, getting higher earnings per share without actually growing revenues, maintaining margins or growing margins, and growing free cash flow. They are really good at financial engineering and really good at making excuses for why the quarter or guidance was not as good as it's supposed to. The Fed's official balance sheet, which I honestly don't believe we need an audit, just like Ron Paul has been promoting with all the crazy purchases of individual corporate bonds and all the other shenanigans. A lot of currency swaps have supposedly been rolling off the Fed's official balance sheet, and over the last 3 or 4 weeks, the Fed's official balance sheet is down almost $250 billion, officially at $248.220 billion. However, the stock market still appears to be juiced. So something doesn't jive with that. Again, this is why we need more transparency in government and with the central banks and Federal Reserve, but I'm not going to hold my breath because I seriously doubt that that will ever happen again, that we're going to get another full audit. So the fundamentals in the real economy are continuing to deteriorate. We have a lot of retail store closings still. Zero Hedge's articles about 88,700 stores closing. We've had Brooks Brothers and others file for bankruptcy that didn't adapt very well. 32% of U.S. households missed their July housing payments, and yet the stock market still doesn't really seem to care very much about this. Eventually, though, if the forbearance periods in the coming 6 to 8 weeks for mortgage payments and commercial real estate and car payments, if those are not extended for forbearance, or the bill comes due and there's bankruptcies, it's going to get ugly. It's going to get very ugly, at least in the real economy. Who knows what the central banks will do with the asset markets or new fiscal stimulus spending. Supposedly, the next round of checks is supposed to be agreed upon either by the end of July or early August in Congress, but it's going to be, I believe, smaller for most people that got their $1,200 checks. Meanwhile, I just saw this article a couple minutes ago before I started the live stream show, this article from Jim Wong from Forbes Personal Finance. These academic Keynesian economists, these PhD economists at universities, 156 of the quote-unquote top economists, yeah, and I'm using air quotes, they're not top economists at all. These are confirmation bias, Keynesians, neo-Keynesians. They want permanent MMT. So I'll attach the article below that in the information and description section. Nearly 50 million Americans in the last, 16 weeks or so since the 16 or 17 weeks since the crisis has started, have filed for unemployment. But what's interesting, and this is, the Fed is really starting to get worried, I think, about the gold price, and the gold price taking off way above $1,800 an ounce, the manipulated paper gold price, because the Fed, a senior official at the Fed this past week, 4 days ago, said that the central bank may slow the pace of corporate bond purchases. And I think that's because they're worried about the gold price, because they're pulling so many levers, they're manipulating so many different markets. They have to be watching the gold price. If they're manipulating the stock market, they're manipulating the bond market, they have to be manipulating the gold price. That's my humble opinion. So if they're going to announce that they're going to cut it back, there's crazy charts with the M2 money supply, the month-over-month, year-over-year growth. It's insane. It's gone fully vertical. So I may do a short video on that sometime this week. I also have my Chris Marcus interview. I have to edit that. Hopefully I'll get that done afterwards. So let's get into the topic for this short video, this live stream show. Famous economist Gary Shilling, and if you're not familiar with Gary Shilling, he's really old school. He was predicting in 1980 when interest rates were skyrocketing higher and Paul Volcker was raising interest rates above the official inflation rate to try to protect the dollar and tame inflation and restore confidence in the U.S. dollar. He was predicting actually a bond bull market, a U.S. Treasury bull market, and a lot of people laughed at him and thought he was crazy. Now, he turned out being right about the bond bull market, especially in U.S. Treasuries. However, in my opinion, Gary Shilling, as smart as he is, was right about the Treasury bull market for decades now for the wrong reasons. So Shilling had been predicting deflation. He's been a deflationist for a very, very long time. But in my opinion, the reason that the treasuries were in a bull market was because of government intervention, a policy of financial repression, the establishment of the over-the-counter derivatives market that exploded in size in the 1990s. And one of the main purposes of the over-the-counter derivatives market is to manipulate interest rates lower so government doesn't have to cut back on its spending, because the U.S. federal government is spending way more than tax revenues, way more than tax revenues. It's enormously larger. The U.S. federal government spending is enormously larger than incoming tax revenues. And the only way for the math to really work is the interest rates have to go lower and the U.S. treasuries have to be sold to pension funds or foreigners. So that's the only way the math has worked. So he was right about, if I could sum up my views of Gary Shilling, of what Gary Shilling said, he was predicting deflation after what Paul Volcker did, and that's why he was bullish on treasuries. The other reason is because a lot of people were buying treasuries and front-running the Fed, because they knew the Fed and the large Wall Street banks that are the primary dealers had to buy these things, so everyone else was buying treasuries to flip it to the Fed or to flip it to other entities. So this game has been going on for bond traders for a very, very long time. And if people think that it's easy money to buy corporate bonds or junk bonds or government bonds, and then they can flip them to the Fed, they're going to leverage up on the trade. They're going to massively leverage the trade if they think it's risk-free. Now, a lot of these trades are not risk-free, but eventually they do blow up at some point with leverage levels. That's what happened with long-term capital management. They were doing a basis trade, a spread trade on different bonds. Government bonds and currencies, and also in the derivatives market. Okay, so let me read this Gary Shilling article. So Gary Shilling, a longtime economist and president of A. Gary Shilling and Company, again delivering a gloomy take on what's next in a recent CNBC interview. I have the CNBC interview. I'm not going to play it. It's got over 580,000 views, and I'll put that at the end of this video if you want to watch it. Okay, so what he said is, quote, stocks are behaving very much like that rebound in 1929, where there is absolute conviction that the virus will be under control and that massive monetary and fiscal stimuli will reinvigorate the economy, end quote, he said, adding that the market could drop as much as 40% over the next year. And then he said, I quote, I think we're going to see downward pressure in prices that works on the advantage of treasury bonds, which have been my favorite since 1981, he said. So if you're familiar with financial history, and I covered this in an article for my over 1,000 Patreon account contributors, the history of after the October 1929 crash, it took years for the stock market to recover, about 2 or 3 years for the stock market to recover even a little bit. It was still going down after the October 1929 crash for a couple more years before there started a rally. And then there was a bull market, a bear market rally, let's just say. It wasn't a bull market. There was a bear market rally from about 1932 to 1937. And then the stock market crashed again, about 40%. And then there was a bear market for another a really painful bear market for another 7 or 8 years after that. And it was very choppy. So in my opinion, and I covered this again in a very lengthy article for my Patreon account contributors behind the paywall, and there's over 100 now articles and audio podcasts and technical analysis chart work. Some of the articles are mixed. Some of the articles are over 5 pages. Some are over 10. There's really in-depth stuff behind the paywall. I doubt you find a lot of it anywhere else, especially for the price. Now, there's newsletters, there's like mining stock newsletters that are $500 a year, and I don't think they cover a lot of the stuff I cover. But anyway, in my opinion, I think what has happened is because of the Fed intervention and social media and people doing day trading with computer on their laptops or on their smartphones or on their tablets, everything that happened from October 1929 to 1937 with the second crash after the bear market rally, it's been condensed really into only about 5 months. That's how crazy everything has been. So we've had literally a roller coaster, and that's why I put the picture up there. And George Gammon has said, he's done a recent video, and I talked about this in my interview recently with George Gammon because he asked me about it, about the stock market rallying even higher to like Dow 30,000 or 40,000. And yes, that is possible. But what's also possible is we're going to have big up moves and big down moves, and maybe multiple of these things. So enormous amounts of volatility that the average person on Main Street is just not going to be able to handle. And that's why the VIX is staying fairly high. I mean, it's not back down into the teens. Again, it's still not that far below 30. So it's made higher lows now, even when it got monkey hammered down after it got above the Lehman Brothers levels. I think that was March or April. It got to at one point, the VIX got above the Lehman Brothers levels. But the VIX is still signaling that there is still problems. And again, I think the problems are with the commercial real estate bust, with the U.S. consumer, once those forbearances on car payments and mortgage payments, residential mortgage payments, and commercial real estate. So I don't see any solution to any of that problem. I think there's still a massive cash flow problem in the real economy. The asset markets may dislocate even more, but if things get bad enough in the real economy, I could see like incredible volatility with big up moves and big down moves in stocks. Gary Shilling also wrote on May 2nd, 2020, he wrote another article for MarketWatch, or at least he was interviewed in there, and he published a op-ed, the article quotes him writing a op-ed on Bloomberg News. I have the MarketWatch article open. I thought I had the Bloomberg News one. Let me see if the Bloomberg one opens. Or if it's going to say that, okay, stock traders should heed the lessons of the 1930s. The economic outlook, this is from April 30th, Gary Shilling op-ed. The economic outlook is not unlike the Great Depression years, and that didn't turn out well for equities. Don't be fooled by the recent rebound in stocks. The investment scene is beginning to resemble the 1929 market crash and the early 1930s Great Depression. In the Roaring '20s, the Dow Jones Industrial Average jumped 500% from August 1921 to September 1929. It then plunged 48% from September 3rd to November 13th, 1929. To many, that seemed like a reasonable correction in the 1920s exuberance. The economy was fully employed and growing rapidly, and most looked forward to more expansion and higher stock prices. Only days before the crash, prominent economist Irving Fisher stated that, quote, stock prices have reached what looks like a permanently high plateau, end quote, and the market was, quote, only shaking out of the lunatic fringe. Also, a 48% stock drop wasn't exactly unique. The Dow fell 48.5% from January 19th, 1906 to January 7th, 1907, in conjunction with the panic of 1907. Still, the economy when there wasn't the Federal Reserve, still the economy, and this is what people cite, a lot of the mainstream academic economists and the people at the Fed, they cite the panic of 1907 as the reason for why the Federal Reserve was created. I think that was just cover, not the real reason, but that's the reason that they claim in public why the Fed was created. Still, the economy didn't collapse, and stocks readily recovered to close at the Dow's old high by the end of 1909. If it hadn't been for what followed, the 1929 crash would probably have been recorded as just one more correction in the wild stock markets at that time. Despite the widespread interest in equities back then, only 10% of Americans owned equities in the 1920s, according to the Federal Deposit Insurance Corp. So stocks rallied 48% until April 17th, 1930, representing a 52% retracement. But as the Great Depression unfolded, stockholders bailed out or were sold out, and the Dow, I think he's talking about margin calls, was sold out. They were forced selling, and the Dow fell steadily until July 8th, 1932, an 86% swoon and a drop of 89% from the September 1929 top. In parallel, the S&P 500 jumped 400% from March 9th, 2009 to February 19th, 2020. Then fear of the global pandemic deflated the index by 34% through March 23rd. But as investors anticipated control of the global pandemic and the effects of massive monetary and fiscal stimulus, the S&P 500 jumped 32% through April 29th, offsetting 53% of the earlier loss. So will history repeat? This looks like a bear market rally similar to that in 1929 to 1930, with an additional 30% to 40% drop in stocks to come as the deep global recession, I would call it a depression, stretches into 2021. In contrast, many look for a V-shaped economic recovery. It's mostly just Wall Street and Congress and the Trump administration and President Trump that are looking for a V-shaped recovery. V-shaped economic rebound with a sharp recovery starting in the second half of 2020. A Bloomberg survey of economists foresees the economy contracting 3.7% this year before expanding 3.8% in 2021, far above the 2.3% growth rate in the previous expansion. I don't believe that. Not when the Atlanta Fed says GDP contracted, I think in Q2, their projections were over 40% is what they were projecting for Q2. I haven't looked at it in the last week to 10 days, but I think it was over 40% projected crash in Q2 GDP. But bear markets that accompany recessions, but then they also are claiming that I think by Q3 or Q4 there will be an 80% rally in GDP. Yeah, I'm not optimistic about that. But bear markets that accompany recessions last about 11 months, far longer than the recent slump. According to Bank of America analysts, the U.S. stock market has never reached its bottom in less than 6 months after falling more than 30% in the face of a recession. Let me add that there's also never been massive amounts of central bank intervention, not just the Federal Reserve, all these central banks, and then all this fiscal policy injection over the last 5 or so months. When you combine all the global central bank intervention and all the fiscal policy injection, there's been this is staggering, $23 trillion. So over $23 trillion in central bank balance sheet expansion and fiscal policy stimulus injections in only 5 months. Welcome to dystopia, solving a debt problem with more debt. The gigantic monthly, and it's not really solving it, it's just keeping the Ponzi going. The gigantic monthly and fiscal stimulus employed so far, with more to come, are unlikely to offset the massive disruption of the global pandemic. Recall that the Federal Reserve's decision to cut its benchmark interest rate to essentially zero, coupled with the huge quantitative easing after the Great Recession, did little to spur the economy, which grew at the slowest rate of any post-World War II expansion. Ditto for the gigantic 2009 tax cuts, rebates, and massive federal spending that together amounted to 6% of gross domestic product. The total decline in stock wealth Gary Shilling foresees will knock 2.8% off consumer spending. This is going to do more than that. Especially if the forbearance on car payments and mortgages, if that is not extended. This pandemic is likely to be the most disruptive financial and social event since World War II, with equally long-lasting consequences. Many will no doubt restrain spending in future years to rebuild savings, not if they have to pay off debt to avoid bankruptcy. Especially since the crisis some people will grow their savings, but then the Fed will want to devalue the dollar. Especially, they won't let the dollar get too strong, especially since the crisis look what FDR did in 1934, because they didn't get the inflation they wanted, especially since the crisis caught them at a time of high debts and short financial reserves. A Fed study found that 40% of people don't have enough cash on hand to cover an unexpected $400 expense. Also, the $600 extra unemployment checks on top of state unemployment benefits may induce some never to return to work. Well, I think they're arguing that now in the second stimulus. So remember, this article came out on April 30th. Especially since those payments will probably be continued into 2021, which means we're going to have MMT for a while. The labor participation rate for working age men has been falling steadily since World War II, and from the late 1990s for women. A widespread economic revival is unlikely until a vaccine and widespread testing are available. Reestablishing supply chains will also be a slow process, especially if the European Union governments and the U.S. want to move factories out of China, or at least some of them. And as seen now with China reopening, a lack of demand from domestic and foreign customers slows the revival. Plus, the lack of international coordination to fight the global pandemic suggests a long recession. In the world we foresee of slow economic growth and massive debt overhang, every country wants to export more to promote its local economy, and none are zealous for imports. So global supply will continue to exceed worldwide demand, resulting in even a bigger savings glut and making chronic deflation a serious probability. Except that the U.S. Treasury and the Federal Reserve can change the rules, and they can do currency devaluations. And we know what the British Empire did towards the end, when the Bank of England and the British government merged, and there was enormous currency devaluations. So the people in power, the policymakers, the monetary and fiscal policymakers, do not want deflation. They can cheat. They can change the rules. What's rule number one? They can change the rules. They will not allow deflation for a long period of time without cheating, without changing the rules a bunch of times, without doubling or tripling down on policies that don't work. Welcome to dystopia. Making chronic deflation a serious probability. And the other thing is, Gary Shilling, like I said, he was right about his U.S. Treasury bull market call, but he was claiming that that was deflation. Talk to anyone who was a young adult in the 1980s who was working and ask them if they had deflation. Ask them for decades, for the last 4 or so decades, if they've had deflation. If their bills, if they've had any deflation whatsoever, ask them. And yet we have these economists, and okay, congratulations to Gary Shilling. He made a lot of money on his U.S. Treasury calls, being long treasuries. However, he said it was because of deflation. It was not because he was not right about treasuries in a bull market because of deflation. He was right because government decided it was going to manipulate interest rates lower. Government decided it did not want to cut spending, wanted to actually increase spending because they could export dollars and treasuries out of the United States. They found China and emerging markets to export those to. And there was a lot of inflation, a lot of currency devaluation since the Treasury bull market started in the 1980 or 81. It's just the government consumer price index, the government inflation numbers don't really account for it. But yeah, they'll still say there's a global savings glut, even though a lot of people are in debt up to their eyeballs. And the entire global financial system is a debt Ponzi, a debt-based fiat currency and credit and debt Ponzi scheme where there's so much debt, over 250 trillion, that cannot mathematically ever be paid back. And yet these Keynesians claim that there's a global savings glut. So there's too much debt that cannot ever mathematically be paid back. Over 250 trillion and growing. They're issuing new debt to try to deal with the old debt. And yet these Keynesians, neo-Keynesians and Keynesians are going on TV. They're making a lot more money than me, by the way, way more, 6-7 figures a year. And they are saying that there's a global savings glut. Doesn't make much sense, but the people on TV are not going to call them out on it because they're invested in the status quo. Okay, there's been stagflate and tax and lie for a very long time, and it can get a lot worse. Okay, so let me take a look at the super chat questions, and then I'll wrap up the short show. A good super chat question from Dmitry Shmerkovich. Thank you for the $10. Why do our beloved higher-ups or rich overlord billionaires, such as Jack Dorsey, are so pro-universal basic income? What's in it for them? I think he's worried about pitchforks and torches. I think he's trying to get some people some loyalty. He's trying to buy his loyalty, because if he's gonna waste his own money funding a universal basic income experiment, if he wants to go broke, let him. It's just very frustrating if government tries to print all this currency, and that's what Joe Biden in the tax plan is talking about. We'll see if he actually agrees and enforces a lot of the stuff he's discussing with Bernie Sanders and AOC. I think right now he's just trying to make sure that he keeps those progressive voters. Because there's people saying oh, Biden's a moderate. If he aligns himself with Bernie Sanders and AOC and the tax policies and the other spending policies that are being discussed, Biden is not a moderate. But again, talk is cheap. So I judge people by their actions. Politicians, talk is extremely cheap. So we'll see what happens. I mean, at this point, Joe Biden is basically is Bernie from Weekend to Bernie's anyway. He would be the first zombie president. Super chat from Walk with Josh. Thank you for the super chat. Where is the best place to learn about mining industries in general? For example, I'd like to know how to analyze drill results. There's mining stock educate. First of all, on my YouTube channel in the playlist section, there's a mining stock education lecture series. I don't know if you've listened to that. There's also mining stock guides. So I can't remember offhand what the website is. Probably have to email me. It might be Mining Stock Education. He's on Twitter, and I think he has a YouTube channel. I think he sells an ebook for a couple bucks where he goes through the stuff. It's like Mining Stock Education or Mining Stock Guide. Sorry, I can't remember the name offhand. If you search though, like Mining Stock Education book for beginners, I think you should be able to find it. I would be very careful with mining stocks though, buying a lot of individual mining stocks. Most retail investors do not understand any of the risks. And we're in an environment now, if the gold price goes higher, some of these miners are going to be aggressive. They're going to overpay for projects. They're going to try to bring on too large of a new mine. And if the New Gold got in trouble with this, I like talking about case studies where miners get in trouble. Goldcorp was a very well-respected gold mining company for many years. Did not have a lot of production problems. And then over the last 4 years, Goldcorp started having problems at Penasquito, which is a large gold and silver mine in Mexico, and a couple other mines. And Goldcorp started having with the production problems because the mine didn't come in at the production levels on time and on budget, and then the balance sheet starts to get hurt. And a very similar story for New Gold. New Gold was actually like the darling mid-tier gold miner. You had Pierre Lassonde, you had a former CEO, Barrick Gold, you had a lot of other big names involved in New Gold. In the 2008 financial crisis, the stock crashed, I think, to like $1 or $2 a share, and I bought a lot of shares in, and then I sold it after it went up 4 or 5-fold. But they overpaid for a junior mining deposit, this deposit called Rainy River, and the deposit did not come in on time and on budget. It was a money pit, and it was nowhere near, the production levels of the mine were nowhere near the stated levels for a while. So it took them, I want to say, over 2 years to get the production anywhere close to where they were planning. And when that doesn't happen, the balance sheet for the miner can get in big, big trouble very quickly. If it's bad enough, the miner can go bankrupt. Okay, super chat from Tarkinas. Thank you for the super chat. Any thoughts on Katusa research opportunities? I don't follow his newsletter. I used to be a subscriber to his oil and energy newsletter when he worked at Casey Research. He's a good writer, and I used to like reading his articles, but a lot of his stock picks did not work out very well. So for the price he charges, I mean, there's a lot of stock picks that have not worked out very well. There was like a diamond company that collapsed, and he was way too bullish on geothermal and problems with the uranium company. He was bullish on uranium for many, many years during the bear market. So no, I don't follow his newsletter. Okay, let me see if I got all the super chat questions. I think that's it. Yeah, one of the reasons I like we walk with Josh, one of the reasons I like the larger royalty and streaming company so much is I don't have to deal with all the craziness at the mining companies. And I used to cover these mining companies a lot, and many years ago I used to write mining stock reports, and for a short amount of time these mining stocks do well, and then the management teams start to get complacent, or they overpay for new projects, or they try to bring a mine online and a ton of problems happen. There's so many things that can go wrong building a new mine, and so many things that can go wrong while the mine is running. And if the metals price is going up a lot, like gold or silver, if gold price goes a lot higher, the government could change the rules with the taxes. It's just a ton of extra headaches, unfortunately. So that's why I like the royalty and streaming companies. You don't have to deal with as much of the headaches of owning individual mining shares. It's like you own a mining stock ETF, except I think the larger royalty and streaming companies are better than owning a mining stock ETF. Jacob asks, any up-and-coming streamers that are solid but smaller than Sandstorm Gold? Yes, Jacob, there is an article behind the paywall for only $5 a month for my Patreon account. It's an article a couple weeks ago about exactly that, and then talking about some of the other newer companies too. One of the newer companies already has 5 or 6 royalties, and the management team has experience already building a royalty and streaming company that was acquired like 5 or 6 or 7 years ago. I give away a lot for free. I've been giving away a lot for free for over a decade, so I can't give everything away for free. And what I charge is way lower than pretty much anyone else. Okay, everyone. Well, thank you for listening. Thank you very much to my over 1,000 Patreon account contributors. It's growing pretty rapidly. There are over 100 pieces of unique content now behind the paywall on royalty and streaming companies, uranium, lots of oil articles. There's articles on the coal ETF. There's articles on, I can't remember if I wrote a natural gas article. I think I wrote one. But hopefully there will be another oil article or two out in the next week or two. And I haven't started working on the other uranium article yet. I did crank out 5 articles, I think, in the last like 6 or 7 days. So there is a lot that came out. Normally it's not going to be that much, but there's still obviously a lot going on. So if there's a lot going on, I'll just crank out an update. It's just me right now. Yeah, I wanted to bring that up. I am looking, if anyone's interested, you can email me, wallstreetformainstreet@gmail.com. I'm looking for a part-time or per-job audio editor because the one I was using, he's no longer doing this. So I'm going to need someone to probably delegate to do some of the chopping up of audio interviews, some of the editing. It'll only be like maybe 1 or 2 interviews per week. So if anyone wants that. Also, I am looking to upgrade my website. So I'm looking for experienced WordPress developers that have like a portfolio of websites I can look at. If you're interested in that or want to refer me to a friend or that's something you specialize in, you can also email me too. Hopefully I can get the website upgraded. I'm not like in a hurry to get it done in the next couple weeks. I'm going to start hopefully speaking to website developers soon. And hopefully I'll get that done. I would like to get it done by the end of the year, but we'll see. That would be nice if I got the website upgraded by the end of the year. But I do need to obviously interview some different website developers first. Okay, everyone, thank you for listening, and thank you very much to my Patreon account contributors who are subsidizing the free podcast because YouTube is a pain in the ass.